Welcome back to The Explainer. So let's talk about Goldman Sachs in 2026. For over 150 years, this firm has essentially been the poster child for Wall Street power, right? Prestige, high-octane profit, the whole shebang. But right now, they're at a totally fascinating crossroads. Today, we're looking at how Goldman is literally shattering deal-making records and pouring gas on the AI boom, while at the exact same time playing a completely different game. They are paying massive premiums to build a boring, stable defense. It's like watching a titan trying to completely rewire itself on the fly. Let's break down exactly how they're trying to shape the future of finance. Okay, here's the game plan for today. First, we're diving into the record profits and those massive AI billions. Number two, paying a premium for stability. Third, we'll look at their global hedges. And finally, we'll zoom out to see the long game. Let's get right to it. Section 1. Record profits and AI billions, the high-octane boom. Let's start with what Goldman absolutely does best, which is making just spectacular amounts of money in high-stakes environments. In Q2 of 2026, they completely crushed market expectations, pulling in $20.34 billion in net revenues. I mean, the equities business alone, that delivered a record $7.42 billion, which is a massive 72% surge from the year before. And investment banking fees jumped a crazy 55% to $3.4 billion. This was driven by a bunch of stock and debt sales and a real pickup in advisory revenue. So, this isn't just a solid quarter, it is a historic acceleration. And naturally, all of that flows straight to the bottom line. Net earnings surged an incredible 78% year over year. That's $6.63 billion. They hit an annualized return on common equity of 23.5%. Basically, they are proving they're ruthlessly efficient at turning shareholder cash into massive profits. No surprise, their stock shot up about 24% to all-time highs for 2026. And underpinning this whole thing, Goldman managed a record-breaking $1 trillion in announced mergers and acquisitions in just the first half of the year. $1 trillion. That is a record pace for literally any investment bank, letting them easily hold on to that #1 spot as a global M&A advisor. Now, the why behind all this unstoppable momentum is what's truly interesting. CEO David Salomon credits the early stages of a multi-year AI investment cycle for this explosive growth. He actually said that the build-out of AI infrastructure will continue to drive elevated levels of strategic activity. Basically, he believes the crazy high capital requirements for AI will keep financing and capital formation highly elevated across global markets for years to come. And speaking of AI, well, that brings us to what might be one of the most critical developments of the entire decade. On August 10, 2026, Nvidia dropped a bomb. They announced a colossal plan, teaming up with major financial institutions to mobilize over $500 billion of third-party capital. The sole purpose here? To fund an unprecedented, massive build-out of AI compute infrastructure. Honestly, the scale of this is pretty hard to overstate. To put it in perspective, Nvidia's data center revenue recently skyrocketed 92% to over $75 billion in a single quarter. The whole goal of this $500 billion initiative is to eliminate the single biggest bottleneck holding back global AI deployment, which is access to capital. Like Nvidia CEO Jensen Huang said, in AI, compute is revenue. What they're doing here is literally turning AI compute hardware, the full stack systems, and the usage-linked revenue into a brand new, highly investable infrastructure asset class. So where does Goldman Sachs fit into this giant puzzle? They actually snagged a coveted, absolute crown jewel role as the sole lender for this initiative, sitting right alongside alternative asset giants like Apollo and Blackstone. How'd they pull that off? Well, years of relationship building. Remember, they advised Nvidia on a nearly $7 billion acquisition way back in 2019, and they led the underwriting on their $25 billion bond sale. So now, Goldman gets to leverage its asset management arm to provide junior capital, so, the higher risk, higher reward debt, while its investment bank will actually place this massive debt into private and public markets. Nvidia itself might even backstop up to $125 billion of this. It's an insanely lucrative, high-stakes position for Goldman. Okay, moving on to Section 2. Paying a premium for stability, the defensive pivot. Now, despite all this roaring success in high-risk M&A and AI, Goldman is actually aggressively shifting gears on another front. They are opening their wallets super wide to buy boring, predictable stability. Right? On August 12th, they announced a really stunning move, acquiring Neos Investments for up to $2.25 billion in cash and equity. Now, Neos is a firm that was founded just 4 years ago in 2022. They manage about $30 billion in assets. So naturally, the big question for anyone watching this space is, Why on earth is Goldman writing such a massive check for such a young firm? The key here is looking at what NEOS actually does. They specialize in options-based income ETFs. Essentially, these are funds that use derivatives, things like covered call strategies, where you sell the right to buy stocks at a specific price to generate cash. And that produces steady, incredibly predictable monthly premium income for investors. In an uncertain market, that is a highly attractive proposition. And the growth here is just explosive. Derivative income ETFs have grown at a compound annual rate of more than 70% since 2021. I mean, that vastly outpaces the broader ETF market.
And this brilliantly illustrates the sheer urgency behind David Solomon's strategy right now. Goldman is paying roughly 7.5% of NEO's assets under management. Let's put that into historical context for a second. When BlackRock acquired Barclays Global Investors back in the day, they paid about 1%. When Morgan Stanley bought Eaton Vance, they paid 1.4%. Goldman paying 7.5%? That is a wild, aggressive premium. But on Wall Street right now, boring safety is basically the ultimate luxury item, and Solomon is effectively paying top dollar for downside protection.
Why? Well, it all comes down to the wealth management race. Solomon is paying this premium to basically rip a page straight out of Morgan Stanley's playbook. Over the past 3 years, Goldman has managed to push its assets under supervision up 50% to over $4 trillion. Which is great, but Morgan Stanley still oversees nearly $10 trillion. Goldman knows they need to aggressively build up these steadier, recurring, fee-based revenues in wealth and asset management. Because when those volatile, high-flying investment banking revenues eventually cool off, and they always do, these steady ETF fees are going to act as a crucial shock absorber. Section 3. Global Hedges. Preparing for the unknown. So this whole defensive posture, it isn't just about wealth management. It extends way beyond that into macro and global hedging strategies. In literally just a few weeks in August of 2026, Goldman made several really fascinating strategic moves across the board. They appointed Chandris Cheda as the co-head of India Investment Banking, laser focusing on one of the fastest-growing emerging markets on the planet. On the commodities front, they very carefully forecasted Brent crude to trade safely between $80 and $90 per barrel, kind of waiting for the dust to settle in global geopolitics. And perhaps most interestingly, they established a $1 billion reinsurance vehicle with Talcott Financial Group. Let's pause and actually define what that last move means. A sidecar reinsurance vehicle. It sounds super complex, but it's basically a financial structure that allows external investors to share the premiums and the losses of an insurance company's specific policies. That $1 billion pool with Talcott, which is based in Bermuda, essentially allows Goldman to share premiums and losses on U.S. annuities. So why does this actually matter to us? Because it perfectly represents Goldman creating yet another completely isolated stream of non-banking exposure. It is diversification in its absolute purest form. And perhaps the most telling indicator of Goldman's cautious defensive mindset behind the scenes is this striking warning from their own strategist. Peter Oppenheimer noted, "Across technology, there does not appear to be a valuation bubble, but there may be an earnings bubble." Let's actually unpack that for a second, because it's huge. Oppenheimer is pointing out that unlike the dot-com era, where valuations hit these insane, completely unmoored highs right before the crash, today's tech prices have adjusted much more modestly. The valuations themselves aren't actually the primary risk right now. The real risk is that the actual underlying earnings of these massive tech giants might be unsustainably high. If those earnings start to normalize or worse, drop, the whole market corrects. And it's exactly this kind of internal mass that is driving Goldman to frantically buy up defensive assets like NEOS. Which brings us to Section 4, the long game, shaping the market. All right, bringing this all together, what's the big takeaway from this dual playbook? We are essentially witnessing a financial titan acting in complete contrast with itself. Over on the offensive side, they're living right on the edge of high-risk, high-reward capital. I mean, they're the sole lender on a $500 billion Nvidia AI financing plan and managing an unprecedented $1 trillion in M&A volume in a single half year. Yet right next to that, on the defensive side, they are aggressively buying expensive downside protection, dropping $2.25 billion on an options-based ETF provider, setting up a $1 billion reinsurance pool. It's wild. They are literally feeding the boom while simultaneously buying the umbrella. Ultimately, Goldman Sachs in 2026 isn't just reacting to the market, they're actively trying to shape it. But as they navigate this huge transition, the billion-dollar question remains, can David Solomon's really expensive bets on stable, recurring revenue grow fast enough to provide a real cushion? Will this aggressive pivot to defense actually save them when the high-stakes M&A music inevitably stops? It's a pretty bold tightrope walk, and you can bet the entire financial world is watching closely to see if they make it across. Thanks so much for joining us for this explainer, and we will see you next time.